Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. It's the start of the financial year, but the carry forward of some old trends. Strength in the US dollar, gold at all-time highs, oil is showing some strength in equities, though a little off, but still remain not far from the highs. Morning, JK, what kind of trends do you expect going
Good morning, Swaraj. Uh, yeah, I think we had a long weekend, and the month of April or the new financial year has started with quite a bit of strength in the dollar and also rise in yields across tenors in US. And this has actually impacted all the financial markets. Main driver has been a series of strong economic data that we saw from the US right from Thursday evening, and starting with the GDP number that came at 3.4% final estimate compared to the previous estimate of 3.2% for Q4 of 2024. And even if you consider that it is a backward looking data, the current estimates for the current quarter is also well about 2.3%, which compares very strongly in relation to many other developed countries. So that was one trigger. Then it was followed by PCE inflation in the US, which is the most closely watched by the Fed also. While the inflation number, both on the headline and the core, came in line with expectations, but they were higher than the previous months. And more importantly, the numbers for November, December, and January were revised higher. So there is no comfort that the Fed would be getting from the PCE inflation numbers, which actually determines their policy approach. In fact, the statements from Powell on Friday in one of the events, while expressing satisfaction that the numbers were in line with the expectations, he also said there was no hurry to cut rates. And one more influential member, Mr. Waller, also said that there was no hurry to cut rates, looking at the price trends recently. Now, if this was not enough, we had the ISM manufacturing activity number that was published yesterday, that came at 16-month high and pushed into expansion territory at 50.3 versus 47.8 that was recorded in February. The new orders, employment, and price component, all of them were higher. And further evidence that the US economy is quite resilient, on most counts, of course. In fact, we also had the jobless claims for the weekend at 22nd March, which showed at the lower end of the expectation at 210,000, showing that the jobs market is still quite okay. And then, of course, we had only one number that was slightly weaker. That was the Chicago PMI, which recorded at 41.4 from 44 in February. But that is one of the regional, manufacturing index only. In fact, that was also followed by Michigan consumer sentiment that came higher than the initial estimates at 79.4. So overall, a picture of very strong US economy, and then the inflation not relenting. All this leading to a spike up in the yields yesterday. Although GDP was published on Thursday, there was not much reaction for the yields because and it was a quarter end. There was a lot of buying in the treasuries due to quarter end considerations. But all of them, along with PCE number and the ISM number, were reflected in yesterday's move in the long term yields of the US treasuries, which rose between 14 and 11 basis points for 10-year to 30-year. And then, of course, the 2-year also rose by about 9 basis points. If you just compare it with what was available from Europe, the initial indications of inflation in Europe has been lower. France and Italy both, came out. In fact, Spain also came out with their flash inflation numbers for March, and they were definitely lower than the previous month. And this strengthens the ECB's hand for cutting rate from June onwards. Some analysts, in fact, expect they may act in May itself, while for US, the expectation for June is also now drifting lower at 56% versus 70 plus percent that was seen last week. Even the rate cuts extent, which was above 75% or 75 basis points last week, is now come down to around 65 basis points. All these stress translated into the strength for the dollar. Of course, euro breaking towards 1.07, sterling also coming towards 1.25 and headed towards 1.24. Japanese yen, which is already on the focus of the market, because it has reached the multi-decade high near 152. Talk of intervention from Japanese officials pervading, but market is not, at least not going below 151. It's trading between 151 and 152. I think we just need one more strong number from US and another rally in the yields to see the 152 mark broken, where some option barriers are stopping it from going higher. A quick move up above 52 may actually bring in selling intervention from Bank of Japan. That is the expectation in the market. Meanwhile, the inflation number from Japan, that is a Tokyo inflation number, which is a some kind of indication of the overall country's inflation, came lower also. So that also is not something that would prompt an immediate next policy tightening by Japan. So all these keeping the yen on the weakness side. But if on the broader picture, yen is too weak. From the COVID lows, it has rallied almost 47 to 48%, and that is keeping the Japanese officials on guard against further weakness, because it can lead to other currencies weakening also. We had some encouraging data from China. The manufacturing, in fact, pushed into expansion territory at 50.8 in February from 49.1. Even the non-manufacturing PMI strengthened to 53. We also had data from on home prices in China rising at the fastest pace in more than 2 decades. Sorry. So overall, Chinese data has not helped the yuan, because I think overall dollar has been strong, yields are higher, and the differential between other countries and US has been widening in favor of US dollar. That remains strong. Of course, we now look forward to the jobs report and the initial indications on job market starting with the ADP numbers tomorrow. So that a lot to look forward to. Now, coming to the Indian rupee, the rupee has settled in the higher range above 83.20 after a pushback above 83 that was seen post the yuan move that was seen in last month, from 7.20 to 7.28. Now, the other factors are also somewhat working towards rupee to remain on in a weaker side, because we have a oil price which is pushing towards 88. We have Asian currencies which are trading at multi-month lows against the dollar. Chinese yuan itself is trading near 7.27. There has been a lull, or rather I would say a slowdown in the FII flows for India as well. Of course, the valuation concerns might be one of the factors, and also the political events ahead may be keeping the FIIs on the sidelines. So taking cues from the dollar index and other Asian currencies, expect the rupee also to be slightly on the weaker range between 83.20, which seems to be a very strong support. In fact, 25 appears to be a very strong support for the USD INR. On the upside, of course, 83.45 will be a point where the central bank is expected to intervene, which is what they have done in the last two attempts. Any break would take it to 83.70. Overall, an atmosphere of strong dollar, that is where we have started the new financial year, but looking forward to more data in the coming days. Thank you.
Thank you, Jack. And the key takeaway for me was, of course, the higher dollar, as well as the recent data from the US economy, which has been on the stronger side. Both inflation has been a little higher, along with growth. And, Fed members continue to maintain the stance that there is no hurry to cut rates. And that has led to even expectations of a rate cut in June coming off. And we have seen the commensurate dollar strength and the rise in yields. For rupee, we have settled in a higher range, slowdown FII flows as well as rising oil prices. They keep a rupee little weaker, along with the broad dollar strength, which is keeping the Asian pact weaker as well. So, a lot to look forward to. 83.45 seems to be the level to watch out for, and a break of that would trigger some more moves. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.